Hi, this is Proic Sam with this live episode of the Living and Working Abroad show. We're broadcasting on Facebook today, but we also run the show on podcasts, Living and Working Abroad on YouTube, as well as LinkedIn and Twitter. Follow us at our website, proicpartnership.com, for more information and guidance on what's happening for expats living and working abroad. We're following up still on the Halloween budget in the UK, what the impact of that is on expats living in the UK and UK expats living abroad. And that's really brought home with the changes to non-dom status, which is what we're going to look at today. In the Halloween budget, the Chancellor announced changes to non-domicile status in the UK from April the 5th, 25, the end of this tax year, start of the new tax year. In fact, changes had already been put in place. So the Labour Party had announced they were going to do it. It was obviously in the thinking of the establishment and the elite parties within the Treasury and the Bank of England and the governments. And all that Labour have done is confirmed what the Conservatives planned to introduce, but tweaked it in a couple of distinct ways. And there's some positives and some negatives for both parties in terms of the impact that it's going to have on expats living and working abroad. So if you've got any questions and you need help and guidance, you can contact us at proicpartnership.com. The non-dom status for expats in the UK was introduced in 1779. So we'll remember that and all the fallen heroes in between time. 1779. And so for 300 years almost, maybe 250, non-doms have enjoyed a status where they could come to the UK as potential investors or expats and not be taxed on their worldwide income. So if you've got dividends or shares or capital gains or earnings from abroad, and you're a non-dom expat in the UK, then you're not paying tax on that worldwide income. And that makes potentially a great place to attract into the UK expats, investors, entrepreneurs, business people, people with wealth to spend in the UK. That was the idea, and that's going now in 2025. So after since 1779, this legislation is now to be abolished, but not completely. It's going to be changed. So foreign income and dividends and capital gains previously weren't taxable in the UK. That if that income or that gain wasn't brought into the UK, are now potentially going to fall into the rule, and that starts on the 15th of on the 5th of April 2025. So it's already in play. It's already in play for existing expats in the UK. It's already in play for expats that are coming to the UK. Let's consider what it means to be non-dom in the UK. At the moment, when an expat who's not British by birth or origin comes to the UK, they're considered to be non-dom. So they can be tax resident for the income that they earn in the UK, but they're not domiciled to the UK. Therefore, they're not liable to unremitted income and dividends from around the world. They only become deemed domicile in the UK when they've been tax resident for 15 out of 19 years at the moment. And that's what's changing. That 15-year rule is being slashed to only 4 years. So that an expat coming to the UK now, after 4 tax years, so if they come to the UK in 2025, after 4 tax years in 2029, they will become deemed domicile in the UK. And therefore, once you're deemed domicile, you're liable to worldwide taxation on your UK income as well as income from dividends, capital gains, earnings around the world, and whether it's remitted into the UK or not. And obviously that gives potentially the UK government scope to tax it up to 45% for uh, income taxes, 39% for dividend taxes, or 40% for inheritance tax. Don't forget that the Labour government have also introduced inheritance tax onto pension plans as well. So people with large overseas pension pots are also potentially under attack there. So it's quite a significant change. Any non-dom expat that's already in the UK, the 4-year rule will apply to them. So if on the 5th of April 25, an expat has been in the UK for more than 4 years, then they will become taxable next year from the 6th of April 25 on their worldwide income, dividends, savings and capital gains. So even though they've come to the UK maybe 10 years ago, on thinking that they've got 15 years of a non-domicile status, that's now changed. So they will automatically fall under, if they've been here for more than 4 years. So any expat that's been in the UK since before 2021 is going to be deemed domicile in the UK from the 5th of April, and therefore taxable as a UK resident, as a UK national would be, on their worldwide income and gains. For more information and guidance on the impact that this will have on you and how you can potentially mitigate or protect your income and business and family and property from some of these taxes, contact us at proactpartnership.com. We offer a free review to all expats as the first call, where we can give you advice and guidance to get you started and see if there's anything practical that can be done. So let's have a look at it a bit more, because it's not just once you're in, it's also once you're out. So once you've been in the UK for more than 10 years, they're tying you into inheritance tax as well. So at the moment, if you're non-domicile, you're not liable to UK inheritance tax. Once you're deemed domicile and you've been in the UK for more than 10 years, then potentially, as a tax resident, and potentially you're also liable to inheritance tax as well. So this gives you quite a lot of worry if you're an expat, because inheritance tax, if you're deemed domicile in the UK, is applied at 40% on your worldwide assets. If you die while you're in the UK. So worldwide assets, potentially 40% of that could be taxable in the UK if you're an expat that's now deemed domicile in the UK. So after 10 years, that could, after 10 years, you're going to be deemed domicile for inheritance tax as well. So after 4 years, you're liable for worldwide income, capital gains taxes and dividend taxes. To 10 years is inheritance tax as well. And once you're in that system, it becomes increasingly hard to get out of that system as well. And therefore, potentially you're liable for that 40% tax on your worldwide property. So if you've got a ranch in Australia, a yacht in the Bahamas, and a business in Germany, but you're deemed domicile in the UK, inheritance tax could potentially be due on all of those. And the big thing to remember with UK inheritance tax, it's due within 6 months of the date of death, so your affairs need to be in order. And if the tax isn't paid on time, there's a 9% tax interest charge on the tax that's due. I can't resist not saying the political thing, but if you've got farmland in the UK government also happy to seize that, so you can put solar panels all over it as well. That's my political bit for the moment. You need more help and guidance on organising and protecting the family's business, property and investments from UK Inheritance Tax Grab, contact us at proactpartnership.com. So I want to look next at how can an expat in the UK that's now deemed domicile in the UK, how can they get away from that? How can you extract yourself from a UK domicile? Well, the good news here is that this is where it begins to benefit UK citizens as well. Inheritance tax is moving over to a residency-based approach. So the statutory residency test that determines whether you're a tax resident or not in the UK is also going to be used to determine whether you're potentially domiciled or not domiciled for that year. So the same statutory residence test that we do in detail to determine your tax residence for the year is also going to apply for your domicile. Now, on the negative side, that brings your liability to the 40% inheritance tax on pensions, property, business, investments, your soul when you die, but also it gives you a scope to find a different way to protect yourself from those liabilities. Now, once you're deemed domiciled, to get away from it, if you've been in the UK for 10 years and you leave the UK, you're still going to be deemed domiciled for UK inheritance tax on worldwide assets for at least 3 years. And depending how long an expat has lived in the UK, if they've lived more than 20 years, then potentially the liability to UK inheritance tax is going to be with them for the 10 years after they leave the UK. So if you're an expat that's lived in the UK as a non-dom for 10 years and you want to leave the UK now, it's still going to be with you after April 25. Still going to be with you for 3 years as a minimum. If you've been in the UK for 20 years, using the statutory residency test to say that you've been in the UK for those 20 years, then it's potentially the inheritance tax liability is going to be with your family for 10 years. So you could retire back to California or Canada or to a Caribbean island in the sun, and the inheritance tax is still going to be hanging over you with a 40% liability on your worldwide assets. However, there's a positive there. If you're a UK expat that's now living and working abroad and you've been outside the UK for more than 10 years, then potentially you could be free of inheritance tax on your worldwide assets. At the moment, a UK expat living and working abroad is still liable for inheritance tax on their worldwide assets. Even if they've got a holiday home in Cyprus, a villa in France, those assets are still liable to UK inheritance tax, even if they've been living and working abroad at the moment for 20, 30, 40 years, because their domicile of origin is the UK. Now, under the old rules, after 20 or more years, you can actually move the dial and make a claim for domicile of choice if it's not the UK. But that's a subjective process where lots of different things need to be done. Now, there's a real measurable way that you can determine whether you're going to have a liability to inheritance tax or not in the UK. So using the statutory residency test, if you've been outside the UK for 10 years, even a UK expat of origin, someone who's born in the UK, British passport, it can still free themselves from the scope of UK inheritance tax, except in one instance. If you're a non-dom expat in the UK that's deemed domicile, or a UK expat with a domicile of origin in the UK, and you leave the UK under the new rules, of a residency-based test for inheritance tax liability, if you've been outside the UK for long enough, which it can be a minimum of 3 years and a maximum of 10, let's say you've been outside the UK for 10 years before you die, you're only going to be liable for inheritance tax on the assets you've got in the UK. So again, it's an important piece of tax planning opportunity there. So if you retired happily for 10 years, you can do what you like in the 11th year. And if you decide that your time has come and it's time to move on in that 11th year, then the only thing that's going to be potentially liable to inheritance tax in the UK is your UK assets. Now that might be a property in the UK, it might be business, it might be an investment shares, it might be a pension fund. Don't forget, pension funds are based in the UK. Unless you move them out of the UK, they're a UK asset. Shares, investments in UK companies, they're in the UK. Your property, your real estate, if it's in the UK, it's in the UK. So all those type of things are potentially liable to inheritance tax, even if you're outside the scope of inheritance tax on your worldwide assets. So it's something to be aware of, and it's part of the planning tactics that you potentially use. So if you're going to leave assets in the UK, how are you going to plan to do that, to mitigate the taxes? Let's consider some of the options that we've got. So you can always give the money away, and in the UK there's limits to what you can do with a trust without it also being liable to taxes up to 45%. Using an international trust in Cyprus, for example, you can hold assets in a family trust without any additional tax liability. So if you can mitigate the liability for any other taxes, there's going to be no tax liability on those funds at all. If in the UK there's an inheritance tax allowance, so between spouses that's 325,000 each way, and to children or blood relatives, immediate family, it's 500,000 if there's real estate involved and it's a gift to families. So potentially a husband and wife, a couple, married couple, could give away £1 million without inheritance tax in the UK. So if you die and your only liability is to UK inheritance tax, and your property and cash is less than £1 million, then there is no inheritance tax. If you're part of the metropolitan elite living in North London, then even a fancy but terraced house in London could be worth 1.5, 2 million quite easily. So those levels can be breached. In other parts of the UK, it's not going to have the same impact. But if you've got a business and you've got investments, or now, don't forget, in the inheritance tax calculation is also your pension fund. All those things go factored and added into a pension fund, into your inheritance tax calculation. As a rough rule of thumb, for every £20,000 of pension that you've got, it's a £400,000 fund. So a £20,000 pension that you're receiving, there's a cash asset behind that of 400,000. Now that's not going to be for the defined pension scheme, because they're coming under different rules. They fall under inheritance tax. It's just where you've got a cash money purchase scheme in place. What we're discussing here is a change in the UK assessment of domicile status. Domicile and tax residency have been seen as two slightly different things. An inheritance tax liability was solely based upon one's domicile, which for people coming to the UK would remain with their home country for up to 15 years. That's changing now. in the USA already, the law states 8 years you're deemed domicile for taxes on your worldwide assets. The UK's changed that now, and it's slightly more complicated, but effectively it's going down the same path. So that if you're an expat coming to the UK, after 4 years, you become deemed domicile and liable to tax on your worldwide dividends, interest, and earnings from abroad. After 10 years, you're also becoming deemed domicile for inheritance tax as well. So an expat that's been in the UK for 10 years then becomes liable to inheritance tax on their worldwide assets in the UK. And that stays with them to the day they die, obviously, that liability. If an expat moves abroad, then for at least 3 years and up to 10 years, they're going to be liable for inheritance tax on their worldwide assets. After 3 years, after 10 years, depending, if you've been in the UK for 20 years, then you've got to be outside the 2 years, UK for 10 years in retirement to lose the tag of inheritance tax liability on your worldwide assets. Once you've been deemed domicile once in the UK, and you then lose that because you've been outside the UK for 10 years, then you're still liable for any UK assets for inheritance tax. However, you've still got that £1 million allowance in terms of cash and property assets based in the UK that are free and exempt from inheritance tax at 40%. Inheritance tax and the changes of non-dom status is a big tax creep from the UK government. In 1779, the non-dom status was brought in to protect a gentleman's worldwide earnings when it comes to live and work in the UK. That's changed now, and the 4 years, the non-dom rules still apply, in which case in the first 4 years you come to the UK on a short-term contract. You're not liable to tax on non-remitted dividends, interest, capital gains. So it still works the same for short-term contracts. Once you've been resident beyond 4 years and you're staying 5, 6, 7 years, you've got a right to permanent residence in the UK and citizenship if that's what you want to apply for. But with that becomes the tag of liability to, first of all, tax on your worldwide dividends, income and gains after 4 years, and then after 10 years, a liability to inheritance tax on your worldwide assets. That liability for an expat on worldwide assets can only be lost once you've been outside the UK for at least 3 years and up to 10 years, and then it falls away, but it's still going to be with you, haunting you to the day you die, a liability to inheritance tax on your UK assets at least. ProAct know how to protect family, business, property, investments, and pensions from these inheritance tax liabilities. As long as we follow the rules, and as long as you make the right plans, and you involve your family, and you do things in advance and in good time, then you can save capital gains tax, inheritance taxes, and other taxes across border and down generations, making sure that it's your family that inherits and not the taxman. A lot of tax keepers come in for non-doms and UK expats living and working abroad. For more information and guidance, contact us at proactpartnership.com. Thanks a lot for listening, and join us next time on the Living and Working Abroad show. Thank you.